If you're pulling 30% out of every 1099 check because some blog told you to, you're probably handing the IRS an interest-free loan of a few $1,000s a year. And the longer you keep doing it, the more compounding you're personally donating to the federal government. On a typical $60,000 freelance year in 2026, the actual federal tax bill after the standard deduction, the half SE deduction, and the 20% QBI deduction lands around $12,378. That's 20.6% of net earnings, not 30%. Based on the IRS 2026 brackets published in Revenue Procedure 2025-32. So, the safe 30% rule is over-reserving by roughly $5,600 for a mid-income solo worker. Every year you park that money in a checking account instead of a brokerage or a solo 401k is a year you don't get back. So, what's the actual number you should pull from every invoice? That's what I want to walk through. By income, by filing status, with the real 2026 math. Okay, let's start with the piece everyone gets wrong first, because it's the piece that makes the 30% rule feel like it must be right. Self-employment tax. You've probably heard SC tax is 15.3% of your income. It's not. It's 15.3% of 92.35% of your net earnings, which is a genuinely weird sentence, but it comes straight from Schedule SE. The IRS lets you knock 7.65% off the top before the tax even applies because W-2 employees don't pay SE tax on their employer's payroll contribution, and Congress wanted rough parity. So, the actual effective SE rate on your net freelance profit is 14.13%, not 15.3%. On $50,000 of net earnings, that's $7,065, not $7,650. Small difference on paper, real difference in your set-aside math. That 15.3% breaks into two pieces. 12.4% is Social Security, and it stops at the wage base. For 2026, the Social Security Administration set the wage base at $184,500, up from $176,100 in 2025. Above that ceiling, the 12.4% just turns off. The other 2.9% is Medicare, and Medicare never stops. It runs on every dollar of net SE income you earn forever. And if you're a single filer earning above $200,000, or married filing jointly above $250,000, the IRS tax on an extra 0.9% Medicare surtax that you cannot offset with the half SE deduction. That surtax is a common quiet surprise for freelancers whose business finally has a breakout year. Here's the counterintuitive part, and I think most tax content buries this. The marginal SE rate actually drops as you get richer. A freelancer clearing $150,000 pays the full 15.3% on their next dollar. A freelancer clearing $250,000 pays just 3.8% on their next dollar of SE earnings because Social Security capped out. That's not a loophole, that's the design. And it changes how you should think about setting aside cash once you cross that wage base. Now the second layer, federal income tax, which stacks on top of SE tax on the same income. The IRS published the 2026 brackets in Revenue Procedure 2025-32 back in October 2025. For a single filer, 10% up to $12,400, 12% up to $50,400, 22% up to $105,700, 24% up to $201,775, and it climbs from there to a 37% top bracket above $640,600. For married filing jointly, that 37% bracket doesn't kick in until $768,700. The One Big Beautiful Bill Act, signed July 4, 2025, made this 7-bracket structure permanent. The previously scheduled snapback to a 39.6% top rate is off the table for good. But you don't pay income tax on your gross freelance revenue, or even on your net profit. You get 3 big shields, and this is where the 30% rule falls apart. Shield 1, the standard deduction. For 2026, that's $16,100 single, $32,200 married filing jointly, $24,150 head of household. Each about $350 to $700 higher than 2025. thanks to OBBBA plus inflation. If you're 65 or older, there's an extra $2,050 unmarried or $1,650 per spouse. And OBBA layered on an additional $6,000 senior deduction available through tax year 2028. Shield 2. You get to deduct half of your self-employment tax as an above-the-line adjustment on Schedule 1. That comes off your AGI before income tax is calculated. So, if your SE tax bill was $8,478, roughly $4,239 of that reduces the income the IRS gets to tax. Shield 3, and honestly the one most freelancers still underuse, the Section 199A QBI deduction. Up to 20% of your qualified business income comes off taxable income, available in full below 2026 thresholds of $201,750 single or $403,500 joint. OBBBA made this permanent, widened the phase-in ranges to $75,000 single and $150,000 joint, and added something new for 2026. A $400 minimum QBI deduction anytime your QBI is at least $1,000 and you materially participate. Which, if you're a Schedule C freelancer doing your own work, you do. So virtually every 1099 filer now walks in with at least $400 knocked off taxable income automatically. Not life-changing, but free. All right, Miles. Now let's actually put numbers on the set-aside percentage by income. Take a single filer with $40,000 in net SE income for 2026. SE tax is 14.13% of that, roughly $5,652. Half of that, about $2,826, comes off before income tax. Subtract the $16,100 standard deduction, subtract the 20% QBI deduction on what's left, and taxable income lands around $16,860. That's mostly in the 10% and 12% brackets, so federal income tax is roughly $1,795. Total federal, about $7,447 on $40,000, or 18.6%. Set aside 19% and you're covered. Bump that same single filer to $60,000 net. SE tax is about $8,478. Federal income tax after all three shields runs around $3,900. Total is that $12,378 I mentioned at the top, 20.6% of net earnings. Set aside 21% and you sleep fine. At $100,000 net SE income, single, the SE piece is around $14,130. Half SE deduction is about $7,065. Standard deduction of $16,100, and the 20% QBI deduction bring taxable income down to roughly $61,388. Federal income tax on that lands near $8,300. Total federal is around $22,430 on $100,000, about 22.4%. So even at six figures, single, you're nowhere near 30%. At $150,000 net single, you're still under the QBI cap, still getting the full 20%, and total federal lands closer to 24 to 25% depending on your specific deductions. That's where the actual set-aside starts creeping up. Married filing jointly with one 1099 earner? The standard deduction is doubled, the brackets are wider, and QBI stays full through $403,500 of taxable income. Same $100,000 net SE income for an MFJ freelancer, whose spouse doesn't work runs closer to 17 or 18% total federal. My take: MFJ freelancers under $200,000 who are still reserving 30% are the single most overtaxed group in the country by their own hand. Now, all these numbers are federal only. If you live in California, New York, Oregon, add your state marginal rate on top. That's where a chunk of the just save 30% advice actually came from, because it was quietly baking in state tax. If you live in Texas, Florida, Tennessee, Nevada, Washington, or the other no-income tax states, The federal-only numbers I just gave you are the whole picture. Your state matters. Your filing status matters. Whether you're contributing to a solo 401k matters, because every dollar you defer into it drops your taxable income dollar for dollar up to the 2026 employee deferral limit of $24,500 plus the employer profit sharing side. Here's the piece almost no one talks about, and it's the reason quarterly taxes stopped scaring me the day I understood it. The IRS Safe Harbor. Per Publication 505, if you pay the smaller of 90% of your current year tax or 100% of last year's total tax, 110% if your prior year AGI was over $150,000, spread across the 4 quarterly deadlines, you owe 0 underpayment penalty. 0. Even if you owe $50,000 at filing. For 2026, those quarterly dates are April 15th, June 15th, September 15th, and January 15th, 2027. All weekdays, no weekend shuffling. The move most growing freelancers should make is to anchor quarterly payments to 100% of last year's tax, or 110% if you're a high earner. Keep the excess reserve in a high-yield savings account or short-term treasuries earning 4-ish% and settle up in April. You get the float, the IRS gets paid on time. Everybody's happy. Well, you're happy. The IRS is neutral. If you skip that and just wing it, the underpayment penalty on Form 2210 is calculated at the federal short-term rate plus 3%, applied to how much you were short in each quarter. Not catastrophic, but annoying and completely avoidable. Real quick on high earners because the math flips. Above the $184,500 SS wage base, the 12.4% Social Security portion of SE tax shuts off. So your marginal SE rate drops from 15.3% to 2.9%, or 3.8% if you're single above $200,000 and hit the additional Medicare tax. What that means practically, a freelancer earning $250,000 has a lower marginal SE rate than one earning $150,000. So the set-aside percentage on dollars above $184,500 is dramatically lower than the set-aside on dollars below it. If you're in this range, don't apply one flat rate to your whole income. Reserve more aggressively on the first $184,500 of net earnings and lighter on everything above. Here's my actual playbook, and this is what I do with my own 1099 income. Under $75,000 net, single, no state tax, reserve 20%. Between $75,000 and $150,000, single, reserve 24%. Above $150,000, reserve 27% on the first. $184,500 and 15% on everything above. MFJ with a non-working spouse, knock about 3 to 4 percentage points off each of those. Add your state's top marginal rate on top if you're in a taxed state. Every 1099 payment hits my account, the reserve percentage moves same day into a separate high-yield account, and I pay estimateds from there 4 times a year. That's it. No spreadsheet gymnastics. Quick housekeeping before I let you go. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this was useful, subscribe. I help solo workers and gig workers stop overpaying the IRS, and I put out something new every week aimed exactly at 1099 filers. If there's a specific freelance tax or retirement question you'd like me to break down next, drop it in the comments and I'll build it into an upcoming video. Next week, I'm digging into something a lot of self-employed folks on marketplace health plans are about to run into. The way your ACA subsidy can quietly vanish at tax time when your 1099 income comes in higher than you estimated, and how to keep from getting clawed back. This video may contain affiliate links. I only recommend tools I use personally. See you in the next one.